Okay, so let us start our class. So good evening, everyone. Tonight we're going to be looking at, we'll start solving past questions on firstly consolidated account, just to apply all of the principles that we have learned and see how you can apply them in your exam questions. And today we are going to be solving that of November 2025, which is last diet. So before I proceed, please confirm that you can hear me clearly.
Okay.
Okay.
Yes.
Okay. All right. Good. So in front of us is November 2025, last diet question. And what's this diet talking about? We're given the requirement. So in the exam, go to the requirement first to know exactly what you're asked to do, so that when you're reading the question, you're reading it with the mindset of what you're required to do. Because you don't want to spend 10 minutes reading a question without creating a mindset, without having or thinking towards the core requirement of the question. So when you look at what this question is wanting us to do, you would see that they want us to prepare a consolidated statement of financial position of the beverages group at December 31st, 2024, in accordance with the provisions of IFRS accounting standards, showing the exchange rate difference, advising on the translation of Coffee PLC net asset. So basically, we are supposed to prepare a consolidated account, and I can see that they want us to show exchange rate difference arising on translation of Coffee PLC net asset. So that means that I'll be saying things like foreign subsidiary in this question. So I'm already prepared for that. Okay, I know that this is 30 marks and they want me to ignore deferred taxation entirely in this question. So looking at the question then, so we have Beverages Public Limited Company. You operate in the service sector. We're told that the statement of financial position of the company and its subsidiaries as of December 31st, 2024 is as follows. So I was given the statement of financial position of three entities: Beverage PLC, Cocoa PLC, and Coffee PLC. Now, Coffee PLC, the reporting currency is different from that of the other entities. Then that means that Coffee PLC would be the foreign subsidiary. So I was given the statement of financial position of these three entities. You can just scan through it. Okay, PP. I can see that investment in subsidiaries. I can see that Beverage invested in cocoa, 169.5, and he also invested in coffee, 69. So this is a scenario of fellow subsidiary, because it was beverages that invested in both cocoa and coffee. And how I'm able to know is that it's only Beverages PLC that has the investment figures in his own books, right? It shows I was one that invested. So this is not a situation of sub-sub. This is that of a fellow, a parent investing in several subsidiaries. So, and that is even more straightforward than fellow, than sub-sub. Okay, so I have other items: financial assets, share capital, retained earnings, other components of equity. Okay, fine. Then I go to my additional information. I was told that the following information is relevant to the preparation of the group financial statements. A, on January 1st, 2024, Beverages PLC acquired 70% of the equity interest in Cocoa PLC. The purchase consideration comprised cash, 141 million. The fair value of the identifiable net assets recognized by Cocoa was 180 million, excluding patent. The identifiable net assets of Cocoa PLC on January 1st, 2024 included a patent which had a fair value of 6 million. These had not been recognized in the financial statements of Cocoa. The patent had a remaining life of 4 years to 1 at that date and is now renewable. The retained earnings of Cocoa were 73.5 million. Another component of equity were 4.5 million. At the date of acquisition, the remaining excess of the fair value of the net asset is due to an increase in the value of land. And I was told in the second paragraph that Beverages PLC wishes to use the full Goodwill method. The fair value of the NCI in Cocoa was 69 million on January 1st, 2024. There have been no issue of ordinary shares since acquisition, and Goodwill on acquisition is not impaired. Third paragraph. Beverages PLC acquired a further 10% interest from the NCI in Cocoa on December 31st, 2024 for a cash consideration of 28.5 million. Okay, so for me, I would really want to make sense out of each requirement. I really want to understand each additional information, what I need them for. So in the first paragraph of the A additional information, so key informations given to me, I can see that Beverages acquire 70% in Cocoa. So apparently Cocoa is our subsidiary, and I know that NCI will therefore be 30%. Secondly, I paid 141 million to acquire that 70%. Also, I was given the fair value of an identifiable net asset of the subsidiary 180 million. And this amount excludes patent. So ordinarily, this should be the net asset acquired that we usually compare with the purchase consideration and NCI. So that's this 180 million. But I mean, they told me that it's excluding Cocoa. Fine. So let's see if they will then give me patent. I said Cocoa is excluding patent. So let's see if they will give me patent, which they did. They said the identifiable net asset of Cocoa at January 1st, 2024 included a patent which had a fair value of 6 million. So ordinarily, this statement itself is rather confusing, right? But I will just focus on, the follow-up. It's like a follow-up from the last sentence because they gave me 180 million and they said, okay, this amount exclude patent. Now, they now gave me the patent. So I just focus on the patent that they gave me. So apparently, you know that when a parent acquires a subsidiary, he can acquire or pay for certain intangibles that are not included in the account of that subsidiary. He will just value it and pay for it. Things like brand name and patent. And that's what's happening here. So all we need to do now is that since this is not already in the books, we need to include them. I've already taught you how we're going to do this. So you will see that again. And also, I was given that the patent has a useful life of 4 years, which therefore means that I will amortize it over 4 years as well. Additionally, I was given pre-acquisition retained earnings of the subsidiary at 73.5 million and also pre-acquisition other component of equity. So other component of equity, if you have not had that before, which I expect that you would, are other items that are in your OCI, which you will take to equity. Items like revaluation reserve or fair value reserve. They are other components of equity, or even actuarial gains and losses, as you have learned them, or fair value reserve through OCI, stuff like that. They are elements of reserves that you find in equity. So at the date when we acquired the subsidiary, it had other component of equity of 4.5 million. It is pre, and it's part of what we are paying for. And finally, we're told that the remaining excess of the fair value of the net asset is due to an increase in the fair value of land. And also, I'm told that beverages uses full goodwill method. Okay, let me stop here a little bit. Just for curiosity. Can anyone tell me what does full, when they say is using full goodwill method, what does that mean? What does that really mean?
Proportionate method, sir.
Proportionate.
Okay. The full goodwill method means fair value. Means fair value, not proportionate. They say full goodwill method. Means fair value, meaning NCI is measured. That's what it means. When they said we are using full goodwill method, that's fair value. And that's why they give us the fair value of NCI, which is 69 million. And that's because it's using full goodwill method, not proportionate. They said there have been no issue of ordinary shares since acquisition, and goodwill on acquisition is not impaired. And also, I was told that this parent acquired additional 10% from NCI in cocoa at the end of the year for a cash consideration of 28.5 million. So that means this question also have piecemeal acquisition, not a big deal, since he acquired only 10%. So that means this is just increase in controlling interest. And when there is an increase in controlling interest, can you remember the principle? What is that only adjustment that we do? Can anyone remember here? What was
Equity.
that? Say it again.
Equity.
Again.
Equity adjustment.
Correct. Adjustment to parents' equity. That's the only thing you do. Okay. So I know exactly what I need to do here because all this information, basically, I only need it for calculation of goodwill or gain on bargain purchase, depending. Because they have given me my holding, date of acquisition is there, 1st of July 2024, how much I paid, what the net asset is, patent, the remaining balance, what it represents, and all that. And I can quickly kill that. I can sort that almost immediately because that is all is needed for. So I know for sure that this guy, beverages acquired 70% in cocoa PLC. Hence, NCI has 30%. So I see in a lot of places, I see people drawing diagram, drawing structure. Nobody cares. You need to understand what is happening. Here we have control, balance, NCI. You don't have to start drawing on, which is why I didn't even bother myself on all that. So let's do cancellation. With this additional information, it gives me all the details for cancellation. So I can easily approach that, right? So let's get that done. So let me do my goodwill. My purchase consideration. I paid 141 million. If you look at it, that's the second sentence. I paid 141 million at the date of acquisition. Then the way we do it, because this is 70%, just so that I'm comparing 100 with 100, I will add what? I will add non-controlling interest. And the examiner already gave me the value of non-controlling interest. How much did they give me as non-controlling interest? That's the second paragraph. How much?
69.
Yes, I was given non-controlling interest at 69 million. 69. So what's the addition of these two guys? What's the addition of these two guys?
210.
210. So with that given, I would net that off or cancel that against my net asset acquired, which is rather straightforward. See, I have two ways of doing it because I already know what my net asset acquired is because the examiner gave me they gave me straight up. They gave me 180, but they said this one exclude patent, but they later gave me patent. So I know it's 186. That's my net asset acquired. But if you look at the last sentence in this paragraph, they said the remaining excess of the fair value of the net asset is due to an increase in the value of land. So that means the examiner expects me to get a fair value of land, which is the remaining excess, the excess of fair value over book value. So I really need to then do what's the way I taught you in class, where I would do share capital. And what's the share capital of the subsidiary? The share capital of the subsidiary, which is Cocoa now, is 57. Can you all see it? Yes, I think you can. 57. 57. Then pre-acquisition retained earnings. How much is my pre-acquisition retained earnings? How much is my pre-acquisition retained earnings? Anybody?
$73.5.
73.5. Okay. Have you all seen it? I can see it. I hope you can all see it. Is in this first paragraph. They said the retained earnings of Cocoa were 73.5 and other component of equity is 4.5. So let's take the two. This is 73.5 and the pre-acquisition other component of equity. Let me just write it in full because some people will not know. One component of equity is 4.5. Then, what again? Also, I was given patents. I was given patents of 6 million. So why is patent coming in as net asset acquired? Yes, it is part of what the parent has acquired. And if I remember clearly how I taught you, this patent, one leg is coming in as a reserve, the other leg is coming in as intangible asset. It's like you're debiting intangible assets, you're crediting reserve. The reserve is what is coming here. This is the reserve leg of that patent. So this patent you are seeing here is the fair value reserve that is here. So don't think it's the asset. It's the fair value reserve leg. It's like a fair value surplus or fair value gain because that asset was not there before. The parent, when he acquired the subsidiary, paid for it. He paid for it. And that's that 6 million you're saying. It's like you're debiting assets. You will see that when I'm preparing my account, there is another leg that goes to asset. And that's the one I'm depreciating or amortizing. Okay. So I have 6. And that is it. That is all my share capital and reserves. However, I'm told in the last sentence, they say the remaining excess of the fair value of the net asset is due to an increase in the fair value of land. So there is also a land that was not in the books before. Okay, not that it's in the books before, but they did not fair value it. When they fair value it, they saw that the value has gone up when they acquired the subsidiary. So there is also a fair value surplus relating to this also. We don't know. They say that's the balancing figure. So the total is 186, which is that 180 plus 6. The 180 given to us plus 6. So please help me sum up 57, 73.5, 4.5, and 6. What does that give us?
141.
141.
141. Okay. So what's 141 minus 186?
45.
45. Okay. So this, just know that this one you're seeing here, oh, fuck. Just know that this one you're seeing here is a balancing figure. It's a balancing figure, 45. So let's get the value of my goodwill. What is 210 minus 186? 210 minus 186. What does that give me?
54.
That's my goodwill. 24. And that's what this first paragraph is doing for me. That's what it's doing for me, first and second paragraph. But I won't stop there, because additional thing that this first and second paragraph is doing for me is that this patent, they gave me the useful life of the patent. They said this patent has a term of 4 years. You know, I told you that this patent of 6 million, when the parent acquired the subsidiary, it paid 6 million for patent. So debit intangible asset, credit reserve. The reserve is what we are taking as part of net asset acquired, because it's part of what it paid for. So it will be cancelled out. But the other leg asset becomes an item in the books of the subsidiary, which has to be amortized. And that takes me to the second item. If this is my workings one, that amortization of patents, and make it my workings two. And it's simply 6 million. The cost of the patent is 6 million. The useful life I was given as 4 years. So amortization per annum is simply 6 million divided by 4. And what does that give us?
1.5.
1.5. So now, who can tell me what's the treatment of this 1.5? Because you need to sort it out immediately. You need to know exactly what you're doing with it.
Okay, hello,
Yeah, hello.
Yes, please go ahead.
You will debit the P or L
Okay,
and credit intangible asset.
okay. Good point. Yeah, you're going to say something, Emmanuel. Go ahead, please. Okay, we don't have so much time. Yeah, you're correct, Beatrice. Debit P&L, credit intangible asset. But for me, I would just say deduct from retained earnings, because I'm not preparing P&L here, right? I just need to know what adjustment I'm supposed to make. That's what's important. I mean, don't bother yourself about debit this, credit that. That's stress. Just know what am I adjusting these things with? That's what's important. And you need to think about it and think about it fast. I know I need to deduct this. It's depreciation, it's amortization. I would deduct it from retained earnings of cocoa. Need to know because this is a subsidiary's asset. And also, I will deduct from the intangible asset, which is that patent of cocoa. It's cocoa that has it. It's in the books of cocoa. And now I'm really sorted with this. I'm done with this additional information one. But I'm not fully done because there is still this third paragraph. There is this third paragraph. So Fasheito already mentioned that to determine that, we just need to compare, he said we need to do adjustment to parent equity. How do you determine that? Who can remember? What exactly are we doing? What exactly are we doing? Who can remind us? Anyone?
We would add the
Okay, he's out. He's out. Anyone who can take it, who can actually take it up from there? What adjustment are we making?
Okay, let me try that.
Yeah, please go ahead, Sharpa.
So it's actually a reduction in NCI. So we restate the NCI, we reduce the NCI to the new value, and that will now be adjusted for in equity of the. Yes, sir. So I said it's treated as a transaction between the owners. So we will look at the difference, the reduction in NCI as a result of that additional purchase. And that is what will be adjusted in the equity of the parents.
Okay, so if I understand it clearly, we're going to do 28.5, which is how much we paid for 10% from NCI. We're not going to compare that with the decrease in NCI. Abi?
Yes, sir.
Okay, so how do you determine decrease in NCI? If you had revised your note, how would you determine decrease in NCI? How would you determine decrease in NCI? So, I can easily do the value of NCI here is 69, right? So I want to say that NCI has decreased by 10%. So can I do 10% of this to get decrease in NCI? That would be wrong. That would be wrong. Because, number one, I bought that additional 10% from NCI at the end of the year. And at the end of the year, NCI will not be 69 anymore. Why? Because NCI will have taken a share of retained earnings of cocoa and also a share of other reserves. So NCI value will have gone up. And what I want to do is the value of 10%. Because what I bought is not 10% of NCI. I didn't buy 10% of NCI. I bought 10% of the company. So if you do 10% of 69, you're wrong. I bought 10% of the company, but it was NCI that gave it up. So I'm going to get that value of 10% relative to NCI. So when I get the value of my NCI at the end, I will gross it up. Whatever I get, I will divide it by 30. That will give me 100%, multiply by 10. That will give me the value of 10%. So I've not gotten there. I've not been able to get my share of post-acquisition retained earnings and all that. So I'm going to hold this one pending because I can't really do much for now. I can't do much for now. So I'll leave this one pending until until I've done my consolidated retained earnings, that I've shared the retained earnings of cocoa between the parent and NCI. Then I can then do that distribution. Now, B. It says beverages acquire 52% of the ordinary shares of cocoa of Coffee PLC on January 1st, 2024, when Coffee PLC retained earnings was 330, let's call this Ghana cedis. We're told that the fair value of the identifiable net asset of Coffee PLC on January 1st, 2024 was 742.5 million. The excess of the fair value over the net asset of coffee is due to an increase in the value of land. The fair value of NCI in coffee at January 1st, 2024 was 375. Again, this is giving me details about the foreign subsidiary. And that's why the currency of acquisition is in another currency. So apparently I have controlling interest because I bought 52%. So NCI is 48%. And I was given the retained earnings of the foreign subsidiary at the date of acquisition. That's the pre-acquisition retained earnings. And I was also given the fair value of the net assets of the foreign subsidiary at the date of acquisition, which is 742.5 million. And I was also told that the excess of the fair value over book value is due to an increase in the value of land. That means just like we did for additional information A, there will be a balancing figure relating to land, which is the fair value of land. Additionally, I was told that the fair value of NCI in coffee at January 1st, 2024 is 3.5 million. Okay, so with this again, I can easily compute my goodwill, but hold up, we can't just jump to goodwill here because these are foreign currency transactions. So let's see how we're going to approach this, because I need to know how I want to translate, because I need to translate all these figures into my functional currency or presentation currency first before I compute anything. So let's see if the foreign subsidiary is an extension of the parent or is an independent foreign subsidiary. Because if it is an extension of the parent, I'm going to translate these transactions like I'm translating normal foreign currency transactions, where I'm going to translate all monetary assets at closing rates and non-monetary assets at historical rates. Not asset alone, items. But if it's an independent foreign subsidiary, that is when I will translate all assets and liabilities at closing rates, share capital historical rates, pre-acquisition retained earnings or reserves historical rates, post-acquisition retained earnings and reserves balancing figure, while also translating my P&L items at average rates. And that is told in the second paragraph. I'm told that Coffee PLC is located in a country in a foreign currency and operates a service business. The income of Coffee PLC is denominated and settled in cedis. The output of the service is routinely treated in cedis, and its price is determined initially by local service and demand. Coffee PLC pays 40% of its costs and expenses in Naira, with the remainder being incurred locally and settled in cedis. The Coffee PLC management has a considerable degree of authority and autonomy in carrying out the operations of Coffee PLC and is not dependent upon group companies for finance. This shows clearly that Coffee PLC is an autonomy or an independent foreign subsidiary. So we're going to be translating asset and liabilities at closing rate, share capital at historical rate, pre-acquisition reserve at historical rate, post-acquisition as balancing figure. Next paragraph. I was told that Beverage PLC wishes to use the full Goodwill method to consolidate the financial statement of Coffee PLC. There have been no issue of ordinary shares and no impairment of goodwill since acquisition. Again, full Goodwill method means that NCI will be measured at fair value. And that I already know because they already gave me the value of NCI. So I don't know why they are giving me this again. I was then told that the following exchange rates are relevant to the preparation of the group financial statement. I was given the opening rates, which is 6 Ghana cedis to 1 naira. I was given the closing rates, which is the rate as at the end of the year, 5 Ghana cedis to 1 naira. And I was given the average rate, 5.8 Ghana cedis to 1 naira. So what am I doing with this additional information B? Number one, when you have a foreign subsidiary, like I told you in the last class, the first thing you do is to translate the statement of financial position and statement of profit or loss of that foreign subsidiary into the parent presentation currency. In this case, from Ghana cedis to Naira. That's the first thing you do. When you have done that successfully, then you can then compute your goodwill, then go ahead and do your exchange difference. You can then do your exchange difference also. Then you can then move to consolidated retained earnings and NCI and all that. So that's the first thing I do here. So I'm going to be doing translation with this. So additional information 3. So I'm going to translation of statement of financial position of Coffee PLC. So I'm translating from Ghana cedis. I will get the rates. I'm translating to Naira. So what are the items I'm translating? I'm translating property, plant, and equipment. How much was it in Ghana cedis? Just put millions so that examiner will know that. I know what I'm doing. What are the figures? PP is 570, financial assets 75, current asset 495. PP 570, financial assets 75, current assets 490? No. So my total assets, what is the total? 570 plus 75 plus 490. It's 495. Are you sure that you guys are here? You're supposed to be participating.
Yeah,
Just wanted to be sure. I was going to say that.
Okay, 495. The total is 1140. Total is 1140. Then the equity and liabilities. I have share capital. I have pre-acquisition retained earnings. Then this one will be the balancing figure. post-acquisition retained earnings. Let me see. So they don't need to tell you. If you look at the share capital, I have share capital, retained earnings. Share capital is 300, retained earnings is 450. So they already gave me the split. They gave me the pre. So I knew that I need to split it. So the foreign subsidiary does not have any other component of equity. So let me do 300. Share capital is 300 Ghana cedis. This is 450. So how much of it is pre in the note 2? Yeah, that's the second paragraph in B. The pre-acquisition retained earnings is 330 Ghana cedis. 330 Ghana cedis. So we have 330 Ghana cedis. Out of 450, so this would be 120. Yeah. Let me just write it there. Balancing figure. 120. So back to my statement of financial position. I have my current liabilities. I have my non-current liabilities 240. I have my current liabilities 150. 240, 150. Non-current liabilities is 240. Current liabilities, that's 150. Then we expect the total also to be 1140. So in translating the rate to use for the PP, I'm going to use closing rates, which is 5. Share capital and pre-acquisition reserve, I'm going to use 6. Okay. So this 5, 5, 5. I'm using 6, 6, 5, 5. So please give me the naira. Am I dividing or multiplying? Yetunde?
You are multiplying.
Why? Why am I multiplying?
The way- the Naira is the parent company. That is the parent company, and is having the foreign subsidiary is having one to is the one buried in one Naira figure. So with that one, since I'm converting to Naira, so you have to multiply.
No, you divide.
Eh?
You divide.
Yes, you divide. Naira has more value. It's 6 Ghana cedis, 5 Ghana cedis to 1 naira. So to get naira, it will be lower. It will be lower. Naira has more value here. So you're dividing. So you need to think about it very well so you don't make mistakes in the exam. So what's 570 divided by 5?
114.
114.
15.
How about this one? 15.
15.
How about this one?
99.
99.
Yes.
Okay, what's the total? What is the total?
228.
228. How about this?
50.
50. How about this?
55.
55. This will be balancing figure, so let's leave it. How about this?
48,
48. How about this?
30,
Sorry?
30.
Okay, 30. So I expect that the balance here too is going to be how much? It will be the same thing as this.
28.
So it's going to be 228. So if you add all of this, 50, 55, 48, 30, what's the total of all of that?
183.
183.
183. Okay.
45.
Minus 228 is how much?
45.
45. That's the balancing figure. So I've written it there as the balancing figure. And I'm done with translation. So I've gotten all the Naira elements. So, and I'm still in additional information B. So thankfully, this question, we don't have statement of profit or loss. So I won't need to translate that. If we had, we will have then gone ahead to translate that as well. But in this case, we don't. So yeah, I mean, work made easy a little. So now I can then go ahead and compute my goodwill first. Okay. So let me go ahead and compute goodwill as workings 4. Now, in computing my goodwill, I would still need the Ghana cedis, the rates, and the Naira. Why? Because goodwill is computed at the date of acquisition. And because of changes in exchange rates, there will be an exchange difference on that goodwill. There will be an exchange difference. And that was how I taught you last week. So in this case now, we have purchase consideration. We paid, how much did we pay in this additional information too? I'm not sure they gave us what we paid. We're not given the purchase consideration. Yes, we're not given. So how can tell me, how do we get the purchase consideration?
Can check the financial statement, sir.
I'll
I
share.
will change the first statement.
Sure. So to coffee, how much did we pay?
70.
69.
69.
69. Is that in Ghana cedis or Naira?
Naira.
Exactly.
Naira.
Okay, good. Because it was in books of the parents. So non-controlling interests, I think they gave us the value of NCI. They give us the value of NCI in B. Okay, that's the last sentence in this first paragraph of B. They give us the fair value of NCI as 375 Ghana cedis. So we're given 375 Ghana cedis. So I'm going to exchange it at historical rates, detail of acquisition. So how much is that?
$62.5.
It's advisable that you walk back to this one also. How much would that be in Ghana cedis? This purchase consideration.
414.
414. So let's sum the two together. This should be 789. Don't know if I'm correct. How much would this be?
121 is 5.
131.5. So net asset acquired. So ordinarily, they had already given me the fair value of the net asset of that foreign subsidiary. They gave me as 742.5. However, in the next paragraph, I was told that the excess of this fair value over the net assets is due to an increase in the fair value of land. So I need that balance. That's why I will need to break it up and get that one as the balancing figure. So I will need to do the normal route. I will do share capital. 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 + 1 I will do pre-acquisition retained earnings. I will do pre-acquisition retained earnings. Then I will do that land, that fair value surplus for that land. Then whatever it is, I'll get the balancing figure. I'll get that as the balancing figure. So for my translated figures, I know that the share capital in Ghana cedis is 300. In Naira is 50. The pre-acquisition retained earnings in Ghana cedis is 330. In Naira is 55. So I can get this as my balancing figure and translate it. So the net assets of this guy, they give me, is it 742 or what? Yeah, 742.5. That's the total net asset acquired, 742.5. $742.5. I can translate it. How much will this give us?
$123.75.
So what's the balancing figure here?
112.5.
So you can either translate this one at 6, or you just get the balancing figure.
18.75.
18.75. Am I correct?
Yes.
Okay.
Yes, sir.
Okay. So my goodwill at 4th January, at the date of acquisition, which is 1st January 2024, of this goodwill of cocoa, of coffee. We have done that of cocoa. Since we have more than one goodwill, I think it makes sense to this cocoa to separate it. So how much is this?
46.5.
46.5. You can translate it or go to do 135 minus this. It gives you the same thing.
7.75.
7.75. Now, there will be an exchange gain somewhere at the end of the year, which is 31st December 2024, because goodwill in Naira will change at 31st December 2024. In this guy's currency, it won't change, it's the same. But we usually translate asset at closing rates. So since we translate asset at closing rates, what would be the Naira value of the goodwill? What's 465 divided by 5 now?
9.3.
9.3. So the value has gone up. Instead of 7.75 is now 9.3. So that's an exchange gain. So how much is the exchange gain? 9.3 minus 7.75.
1.55.
1.55. So this is simply just know that I got it as a balancing figure here, just so that you'd know. And that's my goodwill. Now, there's something that you need to do immediately, otherwise you will not remember, which is this fair value of land. Ordinarily, I should not just touch it. I should just leave it. Okay. There is a corresponding debit as land because I will update the value of my land with this amount. This 18.75 is this credit is the reserve with debit. It's just the same thing here. When I did this one, this patent that I amortized, this land, I didn't say anything about this land because land is not depreciated. Otherwise, we'll have depreciated it. But they didn't give us the useful life. But in this case now, the value of our land at the end of the year will not be 18.75. It won't, because this is a translated figure in the books of coffee. And we translated it at the date of acquisition when we realized it. So there's a value of land 18.75, that's fine. But at the end of the year, the value of the land will have gone up. So that value of that land at 31st December 2024 would go up because at 4th January 2024, as calculated up there, it was 18.75 million. But at 31st December 2024, it won't be that anymore. This 112.5 Ghana cedis, GH, will be translated at closing rates. How much would that give us?
$22.5.
22.5. So the value has gone up. So you see, this is the one that will show, as far as I'm concerned, though, this is the one that will show in my statement in my SOFP as what I will consolidate towards that foreign sub. But there is an exchange gain on this land that I'm going to add to retained earnings of the foreign subsidiary. And how much is that?
3.75.
3.75. So I'm going to add to retained earnings of profit. I know exactly what I want to do with every of my adjustments. Where is it going to? Because that's what matters. What am I doing with this? I know exactly what I'm doing. So I know that this value of land, and the reason I'm dealing with this is because I know there's a corresponding debit. Is a new figure. It's something that just is a balancing figure here. So is what is coming to this cancellation is the reserve. The other leg is the value of land. This is the value at the beginning. The value at the end will not be the same because of translation. To be translated at closing rate, giving rise to exchange gain. I know that my exchange gain, I will add it to retained earnings of coffee. It's going to P&L squared. Now that I've sorted all that, I will just go back and check. Okay, what else? What else? So I've really sorted that part of it. So now I can then go and sort things like retained earnings and NCI. I can sort those ones out now because when I saw my additional information, see, it's talking about something else entirely. So, okay. But I want to be careful when doing retain. I always want to do it last. I can just hold on with the retained earnings and NCI each. Let me sort out all the other because a lot of things go to retained earnings. A lot of adjustments that affect P&L end up in retained earnings. So let me just still leave it. Otherwise, I will have an incomplete solution or a halfway solution. I will now be cleaning and going back and forth. So you always want to do that last after all your adjustments. After all your adjustments, what you can just do, maybe exchange difference. That one is a standalone. It doesn't depend on other adjustments. So my exchange difference. And I know that a lot of you will have forgotten how to do that. So what we do for exchange difference, because the question specifically asks you to compute that, exchange difference from the net asset of the foreign subsidiary, which is coffee. So what I will do is I will try and determine opening net asset, which I'm going to translate at opening rate. Then I work back to closing and compare. So I would do my share capital to get my opening net asset. I will do my share capital in Naira, in Ghana cedis, which is 300, this one. Then I will do my retained earnings also, which is pre and post in Ghana cedis, which was 450, which is this 330 plus 120, everything, which is 420, 450. So this gives me my closing net assets in Ghana cedis, which is 750. If I want to get the opening back, I just need to remove profit for the year. If I remove profit for the year, if I remove for the profit for the year, yeah, profit for the year is quite straightforward because I acquired it at the beginning of the year. Okay. And so he had only made a profit of this post is the profit, it's what he made this current year alone. Because this pre is at the beginning of the year. In fact, what am I doing? So this plus this is my opening net asset. So what am I can easily get my opening net asset 300 plus 330. Because it's 300 plus 330 gives me my opening net asset straight. So let me just call this pre-retained earnings. So gives me my opening net assets. So I will use my opening rates, which is 6 Ghana cedis, to get the opening net assets in Naira. So I'm doing 630 divided by 6. How much is that?
105.
105. Okay, then I'll work back to, I'll do profit for the year, which is that post acquisition retained earnings in Naira, which is 45. 45. I have a total, which is my closing net assets. You remember I called it expected closing net assets. How much is it?
$150.
150. And what is my actual closing net asset? To be the same thing is where is it? 50 plus 55 plus 45. 50 plus 55 plus 45. How much is that?
150.
So we don't have any exchange difference here as on the net asset of this guy. Hold on, I'm coming. So, I mean, it's supposed to, why I'm going through all of this stress, because it means that we have professionally wasted like almost 2 or 3 minutes of our time in the exam when it's going to be 0. So usually in the first year, if that year is the first, that you have not translated, because this is the first year of operations. So as far as net asset is concerned, you might not necessarily have exchange difference. It's in subsequent years you would have, but it's just to be on the safe side that we just say, okay, let's go ahead and do the computation. Now, that being done, let's go to the next additional information, which is additional information C. We're told that beverages has a property located in the same country as Coffee PLC. The property was acquired on January 1st, 2024, and is carried at a cost of 45 Ghana cedis. That's 45 million. The property is depreciated over 20 years on a straight line basis. At December 2024, the property was revalued to 52.5 Ghana cedis. Depreciation has been charged for the year, but the revaluation has not been taken into account in the preparation of the financial statements as at December 31st, 2024. Okay, so how are we doing here? So here now, I'm told that the parent company bought a property in a foreign country. So that this one is that of a foreign currency transaction. He bought it on January 1st, 2024 at 45 Ghana cedis. So this amount, it depreciated. The property is depreciated over 20 years, straight line. And at the end of the year, they revalue the property to 52.5. And the depreciation has been charged. Okay, they have already charged depreciation. Okay, so I won't bother. Has been charged means is they have already put it in the account. They have already adjusted for that already in the books. But they said they have not taken into account revaluation. So I need to take in. That means two things I need to do. I need to translate this to 2.5 to Naira. And that is what will show in my statement of financial position. That's one. Two, since they are not taking account of the evaluation, that means they will not have captured the resulting evaluation surplus. They will not have captured the resulting evaluation surplus. So I also need to take that into account. So let me quickly do those two, right? So they bought it 45 Ghana cedis, okay? Property, that's working 6. Property of beverage, Ghana cedis, million rates, Naira million. So how much was the cost? How much did they buy? 45 to be translated at historical rate minus accumulated depreciation. Okay, can you translate this for me, please?
7.5.
Sorry?
7.5.
7.5. So let me work with the Naira value. So 7.5, what was the useful life that they told us?
20 years.
200. Okay, divided by 200. How much is that?
0.375.
Yes.
375.
Okay, 0.375. That means carrying amount is how much?
7.125.
Compared to the valued amounts. That's 52.5. Translated at closing rates. How much is that?
10.5.
10.5.
Yes.
Okay. So I need to know that this is what goes into my SOFP. And the difference between this is my evaluation surplus. That goes to OCI. Evaluation surplus. So what's the difference? 10.5, 7.125.
3.375. That's minus.
No, it's not minus, so it's positive. The valued amount is higher. Am I correct? Is it 3.375? I didn't hear you clearly.
Yes, you're correct. 3.375.
Okay. So this goes to my OCI. Since I'm not asked to prepare OCI, I will take it to other component of equity. Since they gave me other component of equity. Or let me just put it as equity share. Okay. So, and that's the adjustment for this guy. That's the adjustment for this guy. So let's go to the next adjustment, which is D. I'm told that Beverages started a long-term bonus scheme for employees at January 1st, 2024. Under the scheme, employees receive a cumulative bonus on the completion of 5 years service. Yeah, the bonus is 2% of total annual salary of the employees. The total salary of employees for the year to December 31st, 2024 was 60 million, and a discount rate of 8% is assumed. Additionally, at December 2024, it is assumed that all employees will receive the bonus and that salaries will rise by 5%. Okay, so this is long-term plan, similar to defined benefit plan, just the same way. And that's IAS 19. If you remember, the way we account for this is we used projected unit credits method. And what is happening here exactly is the fact that we are giving bonus of 2% of your annual salary every year. And of course, since your annual salary is increasing by 5%, which is the last sentence here, it means the bonus will rise also by 5% every year. So at the end, when you complete your 5-year service, you get the cumulative. It's not something you get now, you get it when you complete your 5-year service. Meaning that if you don't complete, you won't get it. So for that reason, using projected unit credit method, we will need to accrue for the current year, bonus alone. Okay, for the current year bonus alone. In the sense that we won't say we are owing you the entire amount today. Okay, because we are not. It's until you complete 5 years service before we can give you. So, and if you remember, that's what we call current service cost. So I would probably spread, I'm going to spread, yes, I will need to get the total bonus first. How much is my exposure? How much is the bonus I'm paying to these guys over the period of 5 years? Then I will spread that over 5 years. That, okay, each year this is what I'm owing. Each year this is what I'm owing. And I will build it up every year. I'll build it up every year. Year 1, year 2, year 3. So, long-term service bonus 7. Long-term service bonus. So, using PUCM, projected unit credit method, the entity will accrue for only the first year bonus. This is determined by calculating the cumulative bonus and spreading that over the relevant period, which is 5 years. In this period, we're looking at 5 years. So I need to get the cumulative bonus. What is the total bonus? Cumulative bonus. That is the total bonus. So I know that the annual bonus is simply 2% times annual salary. And I'm told that the annual salary, I think, is 60 million. Yes, 60 million. So times 60. How much is that? How much is that?
1.2.
1.2. Okay. 1.2. So having determined this, that means in year 1, which is December 2024, I'm due to 1.2. In year 2, which is December 2025, this 1.2 will go by 0.5, I guess. 1.05, because I'm told that the annual salary goes 5% every year. So that means this becomes what? How much is that?
1.26.
1.26 in year 3, which is December 2026, the 3rd year. How much is that?
1.323.
In year 4, which is December 2027. How much is that?
1.389.
1.389. 1.389 in year 5. How much is that?
1.459.
1.459. 1.459. So it's going every year. So at the end of the period, how much are we getting? What's the cumulative bonus? Just add all this together.
$6.631.
Sorry?
6.631.
Okay. So what's the bonus per annum? So this, I mean, what I'm trying to do is that since I know that the bonus goes every year, it's going every year by 5% cumulatively. So I need to get what's my commitment as of today? What's my commitment? I know that my commitment is 6.631. So I'm then going to spread that over 5 years, over the 5 years. So I know that per annum, this is what you're owing. So over 5 years, what would that give me? Okay, wait, hold up. So since this is the future value, then let me do the present value of that. So I know what I'm owing. Yeah, let me do the present value of that. So I know the value today. So since they give me discount rates, yeah, I'm giving discount rate of 8%. I'm giving discount rate of 8%. So let me do 6.631 times 1.08 raised to power, how many years? 5 years minus 5. What would that give me?
Sorry, is this supposed to be like annuity or something?
Show the discounting.
Eh, they just give us 8%. They didn't give us like the discounting for throughout the period, or is throughout the period the 8th. I
Well,
thought it
it's
usually
what?
comes as a figure when they are giving it for throughout the period or something.
No, it doesn't come as a figure. So for me to know where I'm using annuity is if I want to get the present value of annual payments or annual inflow. So if I want to get the PV of equal annual payments, I use annuity formula. But if I want to get the present value of a future amount, so I'm going to be paying 6.631 at the end. It's not like I'm paying them every year. It's cumulative. So at the end of the 5th year, I'm paying them, everybody, 6.631. Everybody. So I want to get the present value of that 6.631. I'm not going to use annuity. I'm going to use present value, which is 1 plus r raised to power minus r, right? And since I'm given the discount rate as 8%, the number of period is 5 years. So you won't use annuity here. You're not discounting annual, it's not the annual payments I'm discounting. I'm discounting the future amount. Do you get my viewpoint?
Yes, sir.
Okay.
Thank you, sir.
So, yeah. So what do we have?
4.51.
4.5129.
Four power?
5129.
4.5129. So what is 4.5129 divided by 5 years?
0.9025.
Okay. Now, this 0.9025, is an expense. That's what we call current service costs when I taught you. So since they call it bonus, I will reduce my retained earnings. Retained earnings of beverage is beverage that has this with that amount with 0.9025 for the year, because that's for 2024. And also it's going to be a current liability. I'm going to increase it to be non-current because it's something I'm paying in the future. Increase my non-current liabilities of beverage with 0.9025. Okay, so and that's all. That's all you need to do here. So I mean, Fashion, would you have gotten this right in the exam?
No, sir.
Ha 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 ha. Wow. Well, not to worry, right? Not to worry. So, I mean, you need to practice for the next subsequent classes with you guys. It's past questions I'll be solving back to back. So it's not a class you want to miss any longer if you're really serious about writing this diet. I mean, some people are even leaving. I mean, don't compare yourself with anybody. Some people are just joining for joining sake. They're not writing the exam. So this number one, it's 30 marks, right? And in a 30 marks question, 30 times 1 by 8. So you have like 54 minutes. So just for you to time yourself. Why we are slow is because I'm teaching you, right? And the way they mark methodology. They don't mark your answer. They mark methodology. So don't think if you don't get answer, they will not give you 0. No, no. Even if you have done something, let me check how many marks these workings gives you. That calculation of long-term bonus scheme. Yeah, it gives like almost 3.75 marks, like 4 marks. These workings alone gives you 4 marks. So if you don't get the final answer, at least you show some level of knowledge. You show that you understand how long-term service award, or when you have a defined benefit. This is like a defined benefits plan. You have already promised the benefits in the future to these people. So we just get how much is that benefit, which is what we worked out here. How much is that? I worked out the future benefits. I discounted it to present value. I know that I don't owe this entire amount today, right? What I owe today is just the one they have worked for in this current year. And that's it. So if you have done, however you understand, maybe you'll have gotten 1 mark, 2 marks. I mean, the worst of it all is not to do anything. I don't know this one. No. I don't know this one. No. You get 0. That's what you're going to get, 0. So you need to attempt it. And let's see if luck will shine on you. So that's additional information D. Now, the last additional information. So this talks about, at least you can see that it's not all about group accounts. So when we say question 1 is group accounts, the group account itself is not hard. It's not. Group account is just cancellation. And they are just, the other things that are hard are those other additional information that you need to structure properly. Those are the ones that you need to pay attention to and practice. And I'm going to practice a lot of it with you. So the last additional information says Beverages PLC purchased plants for 30 million on January 1st, 2021, with an estimated useful life of 6 years. Its estimated residual value at that date was 2.1 million. Now said that January 1st, 2024, the estimated residual value changed to 3.9 million. The change in the residual value has not been taken into account when preparing the financial statements as of December 31st, 2024. Okay, so these are another additional information. The parents bought a plant for 30 million 3 years ago, right? Because this is 2024, he bought it January 1st, 2021. The plant has a useful life of 6 years, residual value of 2.1 million. At the beginning of this year, the residual value changed, and they have not taken that into account this year. So for those of you that missed all those classes I'm joining you with those FR students, you have been missing it. This is where you would, even those that did not miss itself might not even be able to get this right. So what am I doing here? So I just need to capture that change in residual value. So apparently they have already recognized the depreciation in the books, right? They have done all that. But what they have not done here is to capture the change in residual value. They did not consider that at all. It wasn't considered. So let's consider it. So that would be note 8. It's talking about a plant. It's talking about a plant and the cost of the plant. How much was it again? 30 million.
2 million.
Cost of the plant is 30 million. They will have calculated accumulated depreciation of 30 million divided by, so what is depreciation per annum, sir? Divided by what? How many years useful life? Is it 20 years? No, 6 years. I think that's 6 years. What am I doing? There was a residual value of 2.1. So that divided by 6. Useful life is 6. So how much is this?
4.65.
4.65. That's depreciation per annum. So accumulated depreciation is deposits times 3 times 4, because this the body in 2021, 2022, 2023, and this 2024. So how much is that?
So was it at the end or at the beginning of 2021?
It's at the beginning of 2021.
1, 2, 3, 4. 4 years.
Okay. This one that I'm
2.6.
even. What did you call it?
18.6.
18.6. So how much is that? What was the carrying amount?
11.4.
11.4. So there was a change in residual value from what to how much? What's the new residual value?
3.9 or something, 0.9.
How much?
So I cannot remember. I think they wrote it in the
Okay.
question.
How much is that?
3.9.
Yes, the new residual value is 3.9. Let me see. Okay, they changed useful life at the beginning of 2024. Okay, so that's 2021, 2022, 2023. I'm not going to count 2024. I'm not going to count 2024 since that is the only thing they have not accounted for. Please help me multiply this by 3, not by 4. They changed the use residual value in at the beginning of 2024. So let me do my
13,
depreciation to
13.95.
13.95. So how much is this carrying amount?
16.05.
15.
16.05.
Okay. So when there is a change in residual value, my depreciation per annum will simply be the carrying amount as at when they changed minus the change in residual value. You said it's 3.9 divided by remaining useful life, which is 3, because it has used 3 years. So how much is that?
That's 4.05.
So now my depreciation should be 4.05, but since they did not consider the change in residual value, they had already accounted for 4.65. So they have overcharged depreciation, overcharge of depreciation on plants by 4.65 minus 4.05. How much is that?
0.6.
0.6. So to correct that, to correct the overcharge of depreciation, I'm going to add, since I've deducted before, add to retained earnings of beverage. And also, since they will have deducted from plants, they will have deducted, so I'm going to add back to plants, okay, to the carrying amount of plant or cost of plants of this guy of beverage. So those are the two adjustments that I need to make for this, just this 0.6. That's the only adjustment I need to, because they have gone to recognize 4.65 as depreciation and all that. They have gone ahead instead of using 4.05 from the current year. They told us in the question that they did not consider the change in residual value. So we have done that. Then you need to correct the overcharge of depreciation by adding back to retained earnings with that 0.6 and also adding to with that 0.6. Okay, Beatrice, I see your hand.
Please, this I want. I don't really need to explain more on how. Why do you know? How do you know that they overcharge depreciation? I'm trying to feature it out. How
Yeah,
you
so
get?
the depreciation per annum that we computed using this is the normal depreciation per annum, 4.65. It's 4.65, which is cost minus residual value. But in between, at the beginning of this current year, they changed residual value, and the question told us that they did not consider that. And when you change residual value, depreciation per annum will change. And this is how we usually compute it, which is the carrying amount from the date of change minus the new residual value divided by the remaining useful life. So that gives me this. So this is the depreciation they are supposed to charge in 2024, but they still charged this. So they overcharge depreciation by 0.6. I need to correct that.
Okay.
So you know that when they charge depreciation, they would deduct from profits and they would deduct from carrying amount. So now I'm adding back what they have deducted. Adding. Now
Okay,
that
thank
I've
you.
done all that, you're welcome. Now that I've done all that, I can then do my consolidated retained earnings now. I can do my consolidated retained earnings. I will do that of beverage. How much is the retained earnings of beverage and those other guys? This 384. This 84. 384, 84. Let me just write down first. 384, 84. How much is coffee? 55 plus 45. That's 100. 100. I'll deduct the acquisition retained earnings. The pre-acquisition of cocoa, I can go and get that from the Goodwill calculation. 73.5. 73.5. And this one I think is 55.
Not 45, yeah.
What is it? It's not 55.
It's
Is it not
55.
45? Okay, yeah.
I can call you back and talk. Is this 50? Wait, I know. Yes, 55 now. Is that what you're saying? Pre-acquisition is 55, yeah. This 55. Then post acquisition retained earnings. So how much is this?
10.5.
Sorry, what is it? 10.5, okay. And
Yes.
I guess this 45.
Yeah.
Okay.
Yes, sir.
All right. So for my workings, first, this one that I'm supposed to deduct from retained earnings of cocoa, amortization of patents, 1.5. Amortization of cocoa, deduct 1.5. That's workings one, I guess. Then, no, it's workings two. I need to correct that. It's workings two. Then there was exchange gain. Exchange gain of coffee. Exchange gain. And this exchange gain, ordinarily, goodwill belongs to parent. Okay? Goodwill belongs to parent. But where NCI is measured at
Fair
fair
value.
value, it belongs to the two of them. NCI 2 will get a share of that. So this 1.55 ordinarily, this exchange gain on goodwill, this workings 2, this exchange gain on goodwill, is that workings 4? Confirm. Ordinarily, I will have just put that 1.55 under parents. But because NCI is measured at fair value, I'll push it to this guy under coffee. And do you know why I'm putting it under coffee? So that it impacts, because I know that whatever post-acquisition profit coffee mix is being shared between the parent and NCI. So by putting it under coffee, it's therefore going to be shared between the parent and NCI. That's the logic, right? So a more difficult way to do it is for me to do 70% of 1.5 or how many percent? Yeah, 52% of 1.55. I put it here. When I get to the parent too, I do 52%, 48%. When I get to NCI, I do 48% of that's difficult. So I just put it here. Automatically they will share. They share it once instead of sharing this one too separately. I don't want to do that. I push it to the subsidiaries so that because this exchange gain was arising from acquisition of that subsidiary. So let them share it from whatever is the remaining. They share it. They both share it anyways. So that's that goodwill. Yeah, it was working for. That's the only one that affects retained earnings here. Also, this one, exchange gain on this land. And this land is that of coffee. It's coffee that has that land because it was as a result of this, it was the balancing figure we got here for this land. So this exchange gain arising on the land, 3.75. Exchange gain on land, I think that's working as 5. 3.75. Exchange gain on land, 3.75. Okay. Here we don't have any exchange difference. If we had, it's not going to, it's going straight to equity. So this one goes to OCI. Okay, it doesn't go to retain earnings. It's a separate reserve on its own. I will have pushed it as an exchange reserve, or since they give me other components of equity, I will have pushed it to other component of equity. So if you're lucky, we'll still see another past question where you will see how I will just go and add that to other component of equity. But in this case, it was nil, so nothing. Another one is this evaluation surplus, okay? And this one is going to equity. So I'll push this one to other component of equity. That's the same way I'll have pushed this exchange difference also there, okay? Then there's this long-term service bonus. I said I'm going to reduce retained earnings of beverage with the 0.9025. So let me push it to that. So bonus. Oh, I don't remember. That's working. Is what again? Is it working 7? Confirm. To come under beverage.
Yes, sir.
Okay, working 7.9025. Then working 8. The plants of beverage. So I'm going to add to retain earnings this 0.6 overcharge of depreciation. I said I'm going to add. So let me just quietly add as I'm adding. So there is nothing more to adjust. So let's get
Yes, sir.
the balance. Yes, I'm with you. Please go ahead.
For the bonus, I think you want to deduct, right?
Yes, so Samuel, thank you. It's an expense. So I'm supposed to deduct. What did I say? How did I put the adjustments? Yes, no. No. Yes, reduce. Okay. So how much is here? How much is what's 10.5 minus 1.5?
That's 9.
9. How about this? 45 plus 1.55 plus 3.75.
50.3.
So let the group take its share. He will take his share of cocoa. He will take his share of cocoa, which is 70% times 9. How much is that?
6.3.
You also take his share of coffee. He has 52% of coffee. How much is that?
26.2.
26.2. Is that what you said?
Yes.
Yes, sir.
Okay. So let's cumulate it together. So let's do 384. 384 minus this, plus this, plus this, plus this.
So is it 384?
Yes, it's 384.
416.2.
416.2. Okay, so that's my consolidated retained earnings. Then my consolidated other component of equity. This is between beverage and cocoa because the other guy does not have other component of equity. So as per the question, which is at the end, beverage had, where is this other component of equity? Okay, under equity and liabilities, beverage had 10.5, cocoa had 6. 10.5 and 6. 10.5, 6. I will deduct pre-acquisition retain and no. Pre-acquisition other component of equity. Now is additional information 1. In the second to the last sentence, when they give me the retained earnings of 73.5 and the days of acquisition, they also gave me other component of equity and days of acquisition, which is 4.5. Okay, so 4.5. So I have 4.5. Then my post-acquisition is 1.5. Other component of equity is 1.5. So what are the items that go to that? One is adjustment to parent equity. I haven't done that. So, and also that revaluation surplus on property from workings what? working 6. This 3.375, 3.375, working 6. Then can get the group share. In cocoa, the group is going to get 70% times 1.5. How much is that?
1.05.
Okay, so I need to determine this adjustment to parent equity. I need to determine this guy. So, and to determine that, I will still need to get the value of non-controlling interests. I'll get the value of non-controlling interest in cocoa and in coffee. So at the date of acquisition, so from my workings up there, at the date of acquisition, I can get all that from my goodwill calculation. My goodwill calculation in cocoa, NCI was 69. In coffee, NCI was 62.5. So 69 and 62.5. 69, 62.5. Secondly, I'll get NCI share in post-acquisition retained earnings from in cocoa. You will get 30% times, what was the post-acquisition retained earnings? Is 9. So what's 30% of 9? I guess that should be 3.
That's 2.7.
Okay, 2.7. In coffee, you will get 48% since the parent has 48% of 50.3. 38% of 50.3. How much is that?
24.14. 24,
34.
sir. 24.14. But
Okay.
I wanted to ask, like, those, okay, you were going to change something. Because I wanted to ask about, like, the difference. Because this 50.3 is for the whole, like, year after acquisition. So I was thinking that we would apportion it for before the extra, before NCI reduced again.
It reducing at the end of the year, so that's why it's not a problem. So it's still going to get.
Okay, I understand.
So also NCI share in post-acquisition other component of equity is just in cocoa alone. We'll get 30% times 1.5. How much is that?
0.45.
Okay. So what's the total here? What is the total here? How much? 69.2%.
96.45. For cocoa, sir.
So how much?
96.45.
96. How can it be 96?
I
69.2.7 plus 8.
I got 72.15.
That's more like it. What about coffee?
62.5 plus 25. Yeah. 86.64.
86 point.
86, sir.
I'm already getting tired, but this question is almost over. So after getting this, so this is the value of NCI at the end of the year. So I can now get decrease in NCI because NCI decreased by 60. So I can do the value of NCI divided by the value is this 30.
Divided by 30 times
10.
their new value. That's times 20.
20 ní kọ́kọ́ times 10.
I think it's 10.
10, which is where we are trying to get
Oh, the
because
decrease. Sorry.
yes. So how much is that?
24.05.
Sorry?
24.05.
Okay. So how much is that? So what's the value of NCI now?
48
What's
points.
48 points?
1.
Okay. So what's then the total NCI value? Which is 48.1 plus 86.64. How much is that?
134.74.
Okay. Now I can then do adjustment to parent equity. How much was the purchase consideration? How much did he pay safe for that?
Statement of financial position.
For the 10%, he paid 28.5. Paid 28.5. Then decrease in NCI from workings 11 is 24.05. So compare the two. What's the difference?
$4.45.
4.45. Is this a gain or a loss?
It is a loss.
Loss. So we paid 24.8 for a value of 24.05. So I will then, that workings 12. That 4.45 will impact this one. Then I can get my
It will
total
be in brackets, sir.
in jackets. So how much is the total?
$10.475.
Okay. Okay, so now we have completed all the additional information. So not all, because I'm still going to just now all is left for me is just to consolidate, right? But just so that I won't be making adjustments on the face of the account, I would also do all those ones in my workings, like this PPE now. I'm supposed to add this plus the translated figure of coffee, then all those new values like land, those two lands that are coming there. I'll need to adjust that. Then intangible assets, that patent that came in and minus amortization like that.
Goodwill.
Then then I'll bring in my goodwill, the translated figures, financial asset, I'll add all of this. Then my current asset, I'll add all of this. Then share capital, that of the parent, retained earnings from workings, other component of equity from workings, current liabilities, add all of this together, plus the translated of the foreign subsidiary, non-current liabilities. I need to remember to add that long-term bonus also to this. Then my figure should balance. So I'm going to do it, right? But I will explain it to you. I will explain it to you like that. So I mean, it's 11 o'clock, after 11. Thank you very much.
Thank you, sir.
Go and
Okay,
revise
sir.
this. Go and revise this. So guys, your exam is very close. Your exam is close. So you need to get the work, get the effort rolling. I won't tell you the exam is easy. It requires a lot of hard work, a whole lot of hard work. And I mean, even me myself, before I came to this class, I had to solve this. This is not my first time solving this question. It would be very unsmart of me to come to teach people and solving it my first time. So I'd solved it. Yes, it was easy for me, even while I was sitting to solve it myself, because we provide solutions to ICANN. So we provide solutions to these things before, like immediately your exam is out, we do the solution, share it out. However, for you, it requires a lot of effort, revisions, especially those additional information. So we're going to make tremendous efforts on those end. And I mean, I will try for you guys. I will try. I won't really leave you alone. We'll just be doing revision with you while you're also reading at the same time. You need to double up your reading and all that. And I would be doing intensive, though it doesn't concern you that much, really. For those of you that have been frequent in class, you really don't need it because it's so much of what I've done, because I saw a lot of past questions with you guys. So for those of you that have been missing classes or that didn't join us right from day one, it's very recommended that you join that intensive class. I'm going to be starting this Sunday, and it's going to be running for 4 weeks. So majorly it's past questions and principles and all that. So, but you that you have been frequent with our classes and all that, you might not necessarily join. It's really not it. But for others that have been missing classes, go and join that, just so that you don't fail this exam. So we have like 5 weeks to go, or maybe 6 weeks. This is when your energy should be high. Energy high. Just try your best as possible. Don't fail. Okay? So I'll leave you with that. See you guys on Sunday. That's when we're going to, I would update you whether we're going to have that Sunday class or not, but I think we should. Yeah. Okay, yeah. So Beatrice, you want to say something?
Yes. Please, the last lecture does
I've not
not be.
uploaded it, right? Yeah, I'm very busy. Even now I'm teaching you out of my base. I'm not in my base right now. So
Because the network is so bad, we expect to at least if person see that one, be able to reverse. Unlike this one today, now many times the network will just lock me out several times.
yeah, I
So
get you. I get you. I'll make effort to get it over tomorrow.
okay, please another question I want to ask. This consolidated question in the exam, the
Yeah.
time it consume, mostly these are additional information. It's so hard that I don't even know how a person like me, how will I be able to cope? Because they will say 45, 50, 55 minutes. How can somebody do this kind of work now? This kind of calculation now for 55 minutes. What
It's
will somebody
practice.
do?
It's
It's so
practice, bro.
tasking. That additional information is a big problem.
It's not a big problem, madam. It's not a big problem, madam, right? It's practice. So you see, the statement itself, let me check how many marks. This, if you, the presentation of the statement itself gives you 6 marks. Okay? It gives you 6 out of the 30 marks. It gives you 6 out of the 30 marks. So, you have 54 minutes to solve this question 1 for 30 marks. You need to, 54 minutes is for 30 marks. So if the question is for 25, don't go and spend 54 minutes. Whatever the mark is, multiply it by 1.8. That's the number of minutes you need to spend. So presentation, the account itself gives you like maybe around 20% of the entire mark, around between 15 to 20%. So you want to delegate some time to workings. As soon as the time you have delegated to your workings is up, leave your workings alone. Go and do the presentation.
Okay.
Yes, go and do the presentation. Just add things together. Adjustment that you have done, put it there. The one you have not done, leave it.
Okay.
You'll be shocked that out of the 30, you might get 20.
So
But
that
by
is
the
what
time
is
you,
that is what that is my problem. The last this thing when I said that I almost spent the 2 hours for only this thing.
yeah, now you didn't plan very well. Please don't do
Um,
that. Don't
Jesus.
ever do that. Don't ever, 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 ever do that. Don't. In fact, don't start with question 1 if you're not so good with it. Don't even start with it at all. Go and start with, there are other simple areas of the exam that you can start with, which I'm going to share with you guys later. There's ratio is there. There is sustainability reporting is there. There will be ethics there. There are some standards that you would have seen before that will be there. Do those ones. With those ones, because that one's like 70. If you're good at them, you will have passed with those ones before you come to this guy. So, and that is really what the focus is going to be now going forward. I'll still be teaching you some principles, but it's more of exam focused up to the date when you're going to write the exams. We'll still be revising. I'm still going to be reminding you on this. SBR is one of the easiest exams to pass because of the section B is there, section C is there where you can maximize mark. Okay. So yeah, Samuel, I see your hand. Please ask your question.
Thank you.
Yeah. Emmanuel, you're muted. Okay. It's not ready. So I'll see you guys
Hello,
on,
sir.
yeah, Emmanuel.
Yeah, evening, sir. So my question is that some videos you haven't uploaded them. Like I think maybe 2
Yeah, I
videos
figured.
on disposal.
Yeah, I figured. It will be done tomorrow on Feeling Leave.
Okay. All right, sir.
I will
Thank you, sir.
start. I'll start pushing it out tonight. So
Okay, all right. Thank you, sir.
you're welcome. Bye.
Okay.